What's up, everybody? This is Kelly Cook, and we are back for another edition of YouTube Live Everything Phoenix Style, which consists of getting right to the point, giving you data, raw data, and having you be fully informed on everything that's going on with the Phoenix real estate market in the local economy. That's what this show is all about. So you get micro specific content for what's happening in the Phoenix area, guys. Thank you for joining us here today. Again, my name is Kelly Cook, and if you would be so kind as to maybe subscribe and like our channel, I would greatly appreciate it. Get us out to more and more people who could use this valuable content, because you won't hear this stuff on the local news or the national news for that matter, because it is too general. This is going to give you the insight as to what's really going on. So if you're watching the replay, go ahead and comment below as well. We read all the comments and we will respond to any questions or thoughts you may have. Maybe I'm off my rocker. Maybe I'm not making any sense, but it's your opinion matters, and we would love to hear it. So if you could go ahead and make this a two-way conversation as much as possible. Now, the situation today. We are going to be discussing the fundamental question that everyone's asking, guys. If there's one question that someone's asking me right now the most, it is why home prices are still rising, not declining, rising, as mortgage rates have even increased. That's right, guys. If you are following what's going on, we know that the Federal Reserve dropped the federal funds rate. That is the overnight borrowing rate between banks. That did come down 50 basis points, which is a big drop. Typically, when they go up or down, for the most part, it's going to be up or down 25 basis points, or it's a quarter point. They came down a half point. That is big. It's not unprecedented, but it's fairly uncommon. And so that was a big drop. So you would have thought that the 30-year fix, the 10-year treasury bond, which it follows, would have responded in kind, but that's not always how it works. And that's not how it worked on this time as well. So what you have now is rates that did fall for a short period of time down to the low sixes, and now have climbed all the way back up to where we were before they even reduced that rate a half point. And it's now at around 7%. That's right, guys. You can't make this stuff up. Why? Well, because the market doesn't really believe the inflation data. I mean, that's really what it comes down to. The market doesn't believe. The people, the smart money, whatever, who are moving money, making bets, futures, etc., aren't really buying the fact that inflation is under control. Even though the CPI may state 2.5%, it is not under control. Why? Because if you go to the local grocery store, guys, you can see that the costs have not come down. It is very expensive. If you go to your local fast food restaurant, your typical meal now for just a burger and some fries and a drink is $10 to $11. That is expensive. If you are trying to shop for auto or house insurance, it is extremely expensive right now. Why? Because the cost to replace things when they break have skyrocketed. So you see inflation all the way around. It's not coming down to the average American, but yet you have, and I think the market is actually reacting as such, because we don't have true interest rates for mortgages coming down that we thought they would. So maybe they will come down if we get better data on the economic side, on the economy side, or economic side, later this week. So let's touch on that, because that's a big thing that's going on. I'm gonna share my screen here, and we're gonna touch on that, guys. So you have a situation here where you have this article here from Yahoo Finance. Fed faces hefty data and political calendar before next policy meeting, guys. So the Fed will meet a week and a half from now. That is the 6th and the 7th of November, which is right after this little thing called the presidential election. So they have some things to work out. It's going to be big to see what they do with interest rates following not just a presidential election on November 5th, which is a Tuesday, but you also have a series of things from the jobs report on Friday, key employment and inflation data as well. That's going to come out, guys. So you have a situation potentially where you could get a trifecta, based upon who gets elected in the White House. You have one thing, then you have inflation data. What if that goes up? What if it doesn't come down? And that won't be good. And then what if you have a jobs report that's not favorable as well? Well, all those things are going to be hashed out before they meet on the 6th and the 7th of November. And then we're going to see how they respond. Will they drop rates further? Will they keep it the same? Or potentially, no one's really talking about this. Potentially, it could go up. I doubt that's going to happen, but it is an option. Right now, the market seems to have factored into play right now that the betting odds are on the fact that the Fed probably most likely will keep it where it is. Why? Primarily because they already reduced it a half percentage point last time, when most people would argue they probably should have kept it at 25 basis points. All right, so you have a lot going on here with our economy and economic news before the Fed meets again and decides what to do. Now let's jump over here into our Cromford report. Now we're going to go from the national economic scene of what's going on with jobs reports and inflation to the local Phoenix area, specifically real estate, right? Here we go. The Cromford report, guys. You can see right now that you have some more red on the board than you do green. What does that mean? That means that there are a lot more suburbs currently that are heading towards a buyer's market or in a buyer's market than typically there have been before. So you can see right now, Fountain Hills still leads the charge way above everybody else for whatever reason, but they're down 7% on the CMI, the Cromford Market Index, right? We know that a balanced market is between 90 and 110 on the CMI. And you can see that being said, you have Cave Creek down to Peoria, all in a balanced market. But you do have Surprise, Goodyear, Queen Creek, Maricopa, and Buckeye, primarily suburbs, all on the West Valley, except for one, Queen Creek, that are in a buyer's market currently. Buyer's market. That's right, guys. Even with the data the way it is, you're still showing multiple cities in a buyer's market. Now, there are some that are in a seller's market. You have obviously Avondale and up. The top 7 are in a seller's market still. Probably doesn't feel like it, but they are. Please note Paradise Valley, number 11 right here. That is the most luxurious real estate in all of the Phoenix area. And they have taken a tumble over the past week or two here, down negative 30% on the CMI, guys. So the luxury home market is doing well in some retrospects, but it is, from a micro standpoint, not doing so well over the past week or two here, right? Demand is a little bit lower, and yet more supply is coming onto the market. Now, let's pivot from that over to this October 19th article here, which I think is really good and important to cover here. Okay, here's what this Cromford Market report is saying. They're saying that days on market, not so good, but listing success rate, a really good measure to pay attention to, okay? So listing success rate is one of the most revealing and reliable housing market indicators, but is rarely measured other than by the Cromford report. That's why you watch this show, Everything Phoenix, guys. In contrast, average days on market is comparatively dull and meaningless, yet measured and reported almost everywhere. We recommend ignoring the average days on market. It might be interesting for a specific single listing, but the statistical average reveals little useful information about the state of the market overall, okay? Our month-to-month listing success rate is 71%. That means out of 100 listings that come on the market, 71 will actually sell, and the other 29 will not. But it's nothing special, but at least it is above the long-term average of 68%, guys. This is the part to really take note of, okay? But it is also below last year at this time when we measured 75%. This tells us that the market is close to normal and not improving much. However, we may not feel like it is close to normal because between 2011 and 2022, the market stayed above normal for almost the entire period. Normal feels much worse than 11 through 22. Also, we have not had much experience of normal years in the last 24 years. It has mostly been better or worse than normal. Those who were active between 06 and 11, that's me right here, will realize how much worse it was back then. And guys, let me tell you something. It was bad, okay? When the listing success rate stayed below 61% and often fell below 40%. Out of 100 homes that hit the market, only 40% of them would actually sell in many, many weeks or months of that time period, guys, okay? We can also see how unusually strong the market was from 2020 through 22 when the listing success rate exceeded 90% for long periods of time, okay? This study and the data of this data reveals that the listing success is generally much higher than average for the lower end of the market and much lower for the higher end of the market. Right now, the success rate for listings above $2 million is 50.6%, while those for the price between 250 and 400 is around 79%. That kind of goes with it, right? But it says overall, be careful to pay too much attention to listing success rate when you're looking at a small sample size of a single zip code. So now let's go down to these cities. Here they are. You can see right here, guys, that right now, Scottsdale, because higher price points, Cave Creek and PV, higher price points are all lower because of the higher price points. Now, PV traditionally will not be above 50% most of the time, even in a pretty good market. It's now at 39%. But look, the buyer's markets, guys, are where the properties are selling the most on the highest success listing rate. Okay. Interesting. I thought it was. Okay. Now, let's get to the root of the issue that we came here today to talk about. We came to talk about why in the world are home prices staying the same or in most cases rising when you have mortgage rates that are actually increasing. Everyone feels, there's that feeling word again, that just because rates are going up, that certainly should make the housing market crash. But it's not happening. Why? Either A, because the person who's giving you, like me, true data is just off his rocker. I guess it could be true. Or B, is because we feel like we let our emotions run the table when making decisions. And guys, that's not the way it should be. Data should guide our decisions. So I'm going to share my screen and we're going to actually go into this article because it's a good one, guys. It's a good one. Here we go. There's the question from Housing Wire. Why are home prices rising when higher mortgage rates are existing? Okay, here we go. This is not a new idea. I've been dealing with people predicting a housing crash since 2012. Okay, doom porn is trendy in America and is usually done by people who hate the Federal Reserve. But today, I'll use data to explain why, even in 2024, the third calendar year of the lowest home sales ever, national home prices have not crashed. Okay, here we go. Now, I love this timeline here, guys. Here are the reasons given why home prices would supposedly crash over the past 13 years, guys. These are what YouTubers, not like me, other YouTubers have been stating for clickbait and headlines to sell their own stuff, have been saying every year. 2012. Oh my goodness. Home prices are going to crash, guys. Do you remember this? I remember it. I've been selling real estate since 2005. And I remember in 2012, people saying, well, the home market's starting to creep back up, but don't go in and buy anything yet because shadow inventory, the banks are going to release all the shadow inventory and prices are going to crash again. Never happened. 13, higher mortgage rates. Not compared to today, but they were higher back then. 2014, QE, quantitative easing ending by the Federal Reserve in October that year. Never happened. 2015, manufacturing recession. 2016, home prices got back to the bubble high. 2017, no good reason. I love that one. 2018, 5% mortgage rates. Oh my goodness, they're so high. Start of the bubble crash for sure. 2019, home price growth was cooling off. Look out, they're going to crash. 2020, COVID, obviously. 2021, and because of COVID, it's going to crash for sure, right? No, didn't. Actually went the opposite way. Mortgage forbearances are on the rise. Look out for the crash. 2022, 7% mortgage rates, which is what happened the back half of 22. Never crashed. 23, historically low housing demand and still hasn't crashed. And 2024 today, higher mortgage rates, higher inventory, sexless men. Okay. Silver to tsunami, right? All the retirees, credit card debt, take your pick. It's all rookie ball. This author is, his choice of words are interesting, right? But he has good data to support the claim. Ladies and gentlemen of the jury, these are not housing experts or analysts. I have a rule. Don't listen to anyone on the internet unless they show their name. Hi, my name's Kelly Cook. Face, there it is. A written 2024 price forecast. Well, I don't really have a written one, but I have a lot of documented videos on YouTube Live. 5 years of home price forecasting and a working model. Been in the business for 19 years since 2005. So why haven't home prices crashed with high mortgage rates this year? Well, if history is our guide, and you should always go to history, guys, because history repeats itself, it's rare for home prices to fall in general since 1942. If you take 07 to 11 out of the equation, we have only We've only had 1 year go negative. That was 1990, and that was only a 1% decline. Now, let that just sink in for a second, guys. 1 year since 1990, and it's only a 1% decline when it comes to home prices falling since World War II. That's wild. Now, that's why when you look at the stats about net worth for Americans in the country, you know there's a huge disparity, guys. Why is that? Well, because home ownership is the number one thing, the vast majority of the time, that will build wealth for an American citizen since 1942. Guys, I think the report said that in 2003, the NAR tracks this, guys, and I'm pretty sure the report said that this past year, the average net worth for the average American that owned one house or more was over $340,000 net average net worth. Compared that to the average renter in America that did not own one property or more, and their average net worth was $13,000 and some change. Guys, that is huge. Well over a $300,000 disparity. And what could that do for your retirement? What could that do for the equity in your house that you could take out to do things like put a kid through college, or maybe help a loved one, or help start your rental portfolio yourself when you go invest in real estate, guys. These are all things that you could do with home equity and what home ownership does for the average American that is one. So I want that to sink in, because if you get nothing more than that off this video, it was worth your time to watch this. But I still have more to cover. Don't leave yet. Okay, here we go. This article is still good, guys. And here you go. When you ask the housing crash addicts why their home price forecasts don't work, they usually say that we should adjust home prices to inflation. Gold prices are some of the silly historical reference that doesn't apply to modern day economics. Okay. Let's look at today's existing home sales report to see if it can explain why home prices haven't crashed year over year. To get a real price crash, we would need to see a surge of housing inventory and distressed sellers. As you will see below, inventory is growing, but it's been calm, a healthy rise in 2024, not a flood of houses coming onto the market. Okay. The NAR existing home sales report shows home sales dropped only 1% from August to a seasonally adjusted annual rate of 3.84 million homes in September. Year-over-year sales are down 3.5%. So here we go. Home sales have been essentially stuck at around 4 million unit pace, about 4 million a year nationally, for the past 12 years. But factors usually associated with higher home sales are developing. There are more inventory choices for consumers, lower mortgage rates than a year ago, and a continued job additions to the economy. Perhaps some consumers are hesitating about moving forward with a major expenditure like purchasing a home before the upcoming election. I love this. I disagree with Yun on this. We have more inventory because demand has been softer, and we have more new listings this year compared to last. If mortgage rates have got below that 6% number, we would have seen a growing home sales regardless of the inventory data, but that hasn't happened. Below are the charts from today's report. Note, the median sales price data is seasonal. Many people will try and trick you by saying home prices are declining in the second half of the year, but these are just normal seasonal price declines. Okay. Using the NAR data, the normal amount of active inventory since 1982 has been between 2 and 2.5 million homes. Okay. 2 and 2.5 million. In 2007, active inventory spiked to 4 million. Today, it's only at 1.39 million homes, with a month supply of homes at over 4 months and getting closer to my target of 1.5 to 1.9 million for active inventory. The housing market is balanced. We have some supply to buy homes. We lack demand. This is true because of mortgage rates being too high and the locked-in effect, right? But you have foreclosures right here, guys, that are still historically low. Guys, look at this. So you don't have this black swan event. Here's what it says. No forced major selling. Below is the data of our new listings, okay? And this data is trending between 30 and 90,000 weekly for the last 5 years of new listings. 30 and 90,000 weekly across America. Compare that to 2009 through 11, and this data line ran at 250,000 to 400,000 per week, guys. That is a huge difference, folks, right? The only time in over 80 years that national home prices crashed was when new listing data was running 3 times higher than what we've seen in the past few years, and that is not what is happening right now in our marketplace, okay? Furthermore, people have a lot of home equity, guys. You can see the equity and the amount of homes that are underwater are obviously very small. And to wrap up this article, which is a phenomenal article to read and get perspective on things, okay, we can see in today's existing home sales report, home sales have declined but are not crashing. I discussed this on the Housing Wire Daily, blah, blah, blah. For national price crash to happen, you need a terrible economy, major distressed sellers, and no help from the government in assisting American citizens, which means you need a repeat of the Great Recession of 2008. The data above shows that isn't the case today. So what do you guys think of that? Okay. Listen, I understand and know that it feels like the prices should come down because affordability is high. No question about it. It feels there should be a housing crash. But if you look at the data and just take your emotion and feelings out of it for just 30 seconds and look at the data, it's not going to happen, guys. It's not going to happen. Now, does that mean that home prices won't come down at all? No, possibly that could happen. If you have the same trend we're experiencing right now and that continues for some reason for a while, 6 months, 12 months, 18 months, you will see home prices come down. But given the data they just shared, it will not be a crash. It will not be this huge thing of 20% decline of home values. It will be a gradual decline, 1% year over year, 5% year over year, something like that, right? Until you see rates respond in kind to get people off the fence and the locked out inventory to now come back onto the markets. So people will move around. Guys, that is the scenario right now that we're looking at, okay? So I hope that really gave you a perspective on data over drama. Don't go off feelings. Use data to guide your direction and your decision-making, not emotion, okay? And unfortunately, the vast majority of people use the emotion side. All right, so here we go, guys. Hope that was good. That was worth the price admission for me as well, just to know that data, guys. And you can see the 30-year fixed right now is at 7%. October 28th right here, 7%, guys. That is crazy considering it dropped all the way down is in the low sixes, 614, 612, 609. Freddie Mac right there. Wow. And now back up to 7, just like that. Okay. So that is interesting. Now let's go over a couple articles from the Phoenix Business Journal because this is a phenomenal source too. Home sales are flatlining amid the affordability crisis. It's affecting down payments as well. So here you go. Down payments in America are starting to recede. This is kind of good news, I guess, in a way, from recent highs, but they're still substantially more than they were pre-pandemic. Our analysis by Realtor.com found that down payments nationally averaged 14.5% as a percentage of purchase price and a median dollar amount of $30,300 in the third quarter. That is down from historic highs observed the previous quarter of $32,700. Okay, so it's coming down, which is good. And by the way, this is a fun stat. In 19 and 20, the down payment average for primary residences was 10.9%. And currently, like we said, it's at 14.5%. So it's gone up a lot since the COVID pandemic. Okay. And then this goes on to talk about everything that has to do with rates and down payments. But guys, the reality is that if home prices are up, because down payment is a factor of a percentage of the purchase price. If the percentage goes up to 14.5% and home values go up, that puts more money out of pocket for most homeowners across America, therefore making it a little bit more difficult to buy a home because you have to have some sort of down payment in most cases. Okay. Now, if you go to this article, this is interesting because where in Arizona, guys, if you're looking to move to Phoenix or move up or down and you already live in Phoenix, where are those zip codes where homes are selling the fastest? Okay. Right here, East Valley zip codes 85284 in Tempe, 85224 in Chandler, 85203 in Mesa led the way in the second quarter with homes in the market for the least amount of days at 55, 56, and 57 days on market, respectively. Okay, that's pretty good. Among the nation's top 10 fastest selling zip codes, 30 days on market was the average time, considerably faster than the national average right now in America of 81 days on market. Okay. And again, you can see the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 or so top fastest selling zip codes in Arizona. And you have a little bit of Phoenix, you have Chandler, you have some Tempe, and you have some Peoria, and so on and so forth, right? So you see all those data zip codes right there. Average home sale price is up 53% in the Phoenix area in these zip codes since 2019. Okay. Amongst the second quarter's fastest selling zip codes, the average price was $1.4 million. You can see the average price points in the zip codes, guys. Here you go. 696 in Tempe, 488 in Chandler, and 468 in Mesa. Okay. So there you go. If you're looking for the place where you're having the fastest selling homes, which is probably going to give you, not guaranteed, the fastest appreciation rates over the next several quarters. Okay. Commercial foreclosures, guys. Now to some development stuff, guys. Commercial foreclosures rise as lenders approach inflection point. We're not going to go through this whole article, guys, but this is interesting. Why? Because if the commercial sector is having a crack in the armor, that could have a domino effect into the residential sector and the overall economy. And so right now you have some national commercial foreclosures peaked in May at 752 across America. And prior to 2020, it peaked in October 14 at 889. So it's back up there a little bit. It's not where it was, but it's something to pay attention to. So hopefully rates will continue to come back down at some point and stay down, not just for a couple of weeks. And people can refinance and get out of bridge loans they have, which is the number one reason why, for the most part, when the market economy doesn't do well, that property's foreclosed. All right, some other development projects to watch, guys. Tempe Town Lake, okay, is a huge area to watch for future development, and just one that has a lot of eyeballs on it because there's a lot of things going on there, right? And it's pretty fun. The South Pier project, I did a video on this project, guys, on my YouTube channel. Check it out. It is a massive project, and it's going to be cool, guys. It is. I flew my drone right by it. I mean, people were waving, construction workers on the 13th floor. It was pretty cool. But guys, 2 luxury hotels, more than 600,000 square feet of high-rise office space, and a multi-acre entertainment district that will include restaurants, nightlife experiences, concert venues, fountain shows, and my favorite of all, a Ferris wheel. There's going to be a Ferris wheel right on the water there in Tempe Town Lake. That'll be really cool. But there's a lot of stuff going on. Then you have the ferry lakeside renovations of these condos here, which is cool. There's the big glass buildings that you can see. You have possible future phases for a watermark, that tower right there, which is right on the water, of course. Mill Avenue High Rise and the Novus Innovation Corridor, guys. A lot of stuff happening in this area. So I'm going to show you that is going on. This is cool. This is one of the top 5 construction projects that is coming down the pike in the Phoenix area that is going to transcend the area of Phoenix in general for the specific reason of entertainment and lodging hospitality. Okay. But the VAI Resort, guys, look at that. Oh, it's going to be just phenomenal. I can't wait to go there and check out a concert, check out maybe the beach. Guys, look at the beach right there. It's like literally going to a beach. It's going to be man-made, clearly, because we're in the desert. But it's going to have the Mattel theme park as well. So it's going to have roller coasters, and it's going to be just a phenomenal place to go out in Glendale by where the Arizona Cardinals play at Westgate. Okay. But they got some zoning approved, and they are cranking full speed ahead. Guys, Amazon opened 3 large warehouses in Phoenix, and they are potentially going to be hiring up to 6,000 or creating up to 6,000 more jobs in the Phoenix area, guys. That is phenomenal. They already employ 36,000 in Arizona. So Amazon is a huge employment hub for the Phoenix area, and they're looking to hire up to 6,000 more people potentially, guys. That is enormous. What a big plus for the Phoenix area. 2 more quick articles, and then we'll wrap this up, guys. This is interesting. Number of electric vehicles in Arizona has tripled, outpacing charging station installation. So this is a big opportunity for, obviously, Elon Musk and the Tesla world to install more superchargers, or the other people who own the generic chargers, because you need them in Phoenix. We need them, guys, because, guys, so listen, Phoenix is so spread out that having an electric car as a daily driver is actually a really cool thing. I have one. I only have one electric car. The other 2 are gas, because there's pros and cons to electric car. But I'm telling you, for a daily driver, you have it all fully charged. When you plug your car in at night, in the morning, it's ready to roll. And guys, for a daily driver, it is awesome. It gives you the acceleration, the power to get to where you need around traffic, and it also it's cheaper to drive around the area when it comes to comparing the cost of electricity that I spend compared to gas. But again, road trips and going up north to Flagstaff or Prescott or someplace like that, not the best. I mean, depending on your battery size, you can make it, but then you got to charge when you're there, and that takes time. And just, I would prefer to do that road trips with gas powered vehicles. But for a daily driver, the electric vehicles are pretty sweet. I will say that for someone who drives a decent amount, being a realtor driving around town, that is pretty cool. All right, last but not least, guys, we got to end on some fun. It is October, the end of October, and it is never too early to start talking about the greatest show on grass, and that is the Phoenix Open, the Waste Management Phoenix Open, the PGA signature event that happens every single year in early February in the Scottsdale area at the TPC course right there. And they are talking about actually doing some improvements with a second entrance and wider walkways. Is just some of the things that are coming to the 2025 Waste Management Phoenix Open, guys. I'm going to share my screen now, but let me tell you before I share my screen, if you have not been to the Waste Management Phoenix Open, you got to go. But unlike golf, I don't care. You got to go. You barely even see any golf. You're out there having a good time, meeting people, free food, drink based upon the kind of ticket you get. And there's just great people watching and sightseeing. And then if you want to watch some really good golf, they got that too, right? It's like a party that just happens to have a golf tournament there. It is one of the most unique events you should go check out. So I'm going to share my screen now so you can see that what I'm talking about here, because you can see a good aerial photo right here of the Phoenix Open. There's the course, the TPC Scottsdale, which is a very nice course and very expensive to play. It is public, but expensive to play. They will give you a 4 caddy, and you're gonna pay $400, $500, $600 all around. That's right, during season, right before or right after the TPC Scottsdale Waste Management Open is done. So pretty cool. Got a question here. Love it. All right, here we go. KD0211. How you doing? Thanks for watching and supporting the channel. If you look at data factoring interest payment, home insurance, maintenance, etc., do you still get positive equity purchasing a house? Do you still consider it a positive investment long term? And that question unequivocally for me is yes. Now, if you said short term, that'd be different. But when you say long term, unequivocally, no question about it, the statistics do not lie. In the short term, potentially if you have to sell your house and you're not going to hold it, after these costs that you just mentioned, yes, it may be a better situation in those type of scenarios, potentially to rent. It very well could be. But I'm telling you guys, even if you have the ability at all on your exit strategy to own a home, whether you live there or not, to own that home and have the principal buy down occur over time, wow, appreciation naturally sets in, even if it's slow going appreciation, man, what a gift that is to have in your financial portfolio for that property, because it will always pay off in the long run. Furthermore, you have tax deductions with that property. If it's a owner-occupied property, you have tax deductions. I mean, just the fact that you can have a write-off as a single individual of $250,000 of proceeds of appreciation when you go to sell, and up to $500,000 tax-free. If you're a married couple, is a phenomenal tax exemption right there. And then, of course, if it's an investment property and you file it on your Schedule E, you have all kinds of tax incentives you can do. But the one that no one talks about hardly at all is depreciation, guys. And that is the magic pill when it comes to real estate investing. Depreciation on residential and commercial real estate alike, in my opinion, nothing beats it. Good question. Okay, how would you define long term? Well, it depends on a market cycle. Market cycles typically, on average, last 7 years. But you have these cycles recently where, outside of COVID, KD0211, you have a cycle where we've been on a bull run really since 2012 in Phoenix, at least. Obviously, prices did go down a little bit in 2020, right when COVID first hit, but then it just skyrocketed after that. So cycles do happen. The average is about 7 years. So I would look at 7 years as a general rule of thumb. But typically for Phoenix, maybe more closer to 5. But if you're willing to hold it for 4 to 5 years, and if you use 7 as a general thumb, man, home appreciation just is a phenomenal thing. Now, I will say this too. If you go back and look, there's a good argument that could be made that home values will double in certain markets across America that have strong wage growth, strong job growth and creation, population influx more so than the outflux. Phoenix checks all those boxes. That typically in those situations, home values will double on average every 10 to 12 years. So just think if you got a 30-year fixed mortgage, locked that payment in, which is a great hedge against inflation for 30 years, and just kept it for 30 years. Think about that. And you're in a place like Scottsdale, Phoenix, Chandler, or any, pretty much any place around the Phoenix area for the most part. And it doubled every 10 years. Just do the math on that based on the price point you purchased your house at. Something to think about. Okay, but you got to think long term. Most people don't. Most Americans think it's a microwave economy, right? Short term, and you got to think long term. But going back to, by the way, if you have any questions on this, I geek out on home appreciation and personal finance and long term investing. Call me 480-660-5974. 660-5974. 480 is the area code. I would be happy to have a conversation with you guys. Shoot me a text, call me, whatever. We can schedule time. Love to talk that all day long. Going back to here, nothing more to talk about really much on this outside of the fact that if you haven't been, you should go. There's a Coliseum. That's hole 16. It's a par 3. And there's General Mission right here. People go crazy. You have all these luxury suites around here. It's just a phenomenal time to go enjoy a beautiful day that's usually highs in the low 70s. Just you can't beat it. You really can't. Now, obviously, it rained a lot last year. That's like there's a picture of one of the days, so that's not good. But that's usually pretty rare. Usually it is phenomenally beautiful that time of year, and you should come check it out. All right, that's all I have here. My time is up. We went a little long. Thank you for sticking around for this. One more thing. If I call, am I talking to you directly or one of your assistants? Well, we have a good question. You will talk to me if that's what you want to do, because even though an assistant might answer the phone, if I don't answer it in time, because we have this system where we will try to answer the phone within like 5 rings and not let it go 7 or 8 for customer service purposes. But you ask for me, I will definitely take your call and help you on any way I possibly can. That's what I'm here to do, advise. So thank you for that question. Give me a call, 480-660-5974. Guys, until next time, thank you so much for the participation, and I'll try to bring the value every single time I can when we have one of these shows that are live, which is almost every single week, almost throughout the year. And guys, until next time, Phoenix, like I always say, keep it classy.